Hello, I'm Kerry Griffiths and this is Willow Brook Lifestyle Financial Planning YouTube channel. Today I have a guest along and we're going to talk about a part of divorce that often gets overlooked in the first instance and can actually be a surprise for women when they find out a little bit more about it. So we're going to talk about tax, and the aim of this video is to make sure that you are aware of some of the key impacts of tax when you're getting divorced and when you're separating. So it's not to get you an expert on tax or actually give you the details on how to calculate your tax, but really to give you the alarm bell so that you have in the back of your mind that you might need to find out more, you might need to get an accountant involved, and you might need to speak to your solicitor in a bit more detail about certain areas. So if you are getting divorced and you haven't thought about tax yet, then this is the video for you. And I am really delighted to have an absolute expert in this come along. So I've got Sam Hart with me. She's the head of private client tax at Claritas Tax. She's been working in private client tax for over 20 years, and she's specialising in advising entrepreneurs and wealthy individuals on their tax affairs, particularly on capital taxes, capital gains taxes and trusts. And she's going to outline a little bit about that for us today. So welcome along, Sam. It's so wonderful to have you with us. Do you want to just give us a little bit more about you and your background?
Yes, thanks for having me, Kerry. It's lovely to be here. Yeah, as I said, I've worked in tax for over 20 years, advising people mostly on capital taxes, things like capital gains tax, but also inheritance tax, but also anything to do with individuals tax, really, and making sure that they and their families know what they're doing with their tax and how to best structure their affairs.
Because it can be a minefield. You need experts on your side, absolutely. So we're going to talk about the main things that come up when you're getting separated and divorced. And I'm specifically mentioning the word separated, which I don't do a lot on this channel. We tend to focus on divorce. But actually, when it comes to taxes, separation is really, really quite key. And actually, that first year of separation, Sam, that's a really important one to have in your mind, isn't it? So do you want to start there, Sam, and tell us a little bit more about why that's so important?
Yeah, I mean, if just to step back a second, if I may,
Of course.
quite often people might approach a divorce and think, well, why do I need to think about tax? Because it's not really a tax event.
Yeah.
But the problem with that is there's a tax called capital gains tax, which, in case people aren't aware, it's basically a tax on the increase in value of investments that you hold. So a good example would be if you bought shares in a blue chip company, say Marks and Spencer's, and you held those shares for 5 years, and when you sold them, they were worth twice as much as you bought them for. Capital gains tax taxes that gain on the intervening time period. The rates are lower than income tax rates. The main rates are 10% and 20%, but there are higher rates on residential properties at the moment. The problem is in a divorce, unless the two parties to a divorce already hold all of their assets equally, which, as we know in practice, never happens. At some point during the divorce proceedings, one party is going to have to be giving assets to the other party to equalise their position, quite often as part of a settlement. The problem is that actually constitutes a disposal for capital gains tax purposes.
Yeah.
Now, spouses, and I'm going to use the word spouse here to include married couples and also civil partners. Spouses benefit from a special tax treatment in that they can transfer assets between themselves and no capital gains tax arises. It's a specific section that allows that to happen. The problem is that once you stop being a spouse, that exemption doesn't apply anymore. So any asset transfers are going to fall under a CGT or potentially generate a CGT liability. Now, hopefully, for tax purposes, the definition of when you cease being a spouse depends on the tax. But for capital gains tax, which is a tax that we're generally most concerned with in divorce, that point is the point of permanent separation. So permanent separation in many cases is obvious, but in some cases it might not be. And it isn't necessarily restricted to location. You could still be married and be living in different countries, or you could be permanently separated living in the same house. So there are sometimes grey areas, but generally once the permanent separation has occurred, you only benefit from the spousal treatment of transfer of assets until the end of the tax year in which you separate. which is of course fine if you can plan your emotional life around the tax year. A little bit less tricky if your partner walks out on the 4th of April.
Yeah, absolutely, because it runs April to April, and so yeah, and it can fly by. It can be one of those periods of time where you're testing the waters and actually might not even be talking to solicitors at this point around divorce, so they're not raising capital gains tax with you, and that's the purpose really, is just so you have this awareness and this alarm bell in your mind to be thinking, you know, there could be some steps that you can take in that first year, and to seek some advice and some guidance if you're likely to be able or likely to be paying tax, likely to experience any gains at all. Now, there are some specific rules around the main home being transferred with some extra considerations. Sam, could we delve into that a little bit too, please?
Yeah, I mean, again, it obviously with anything in tax can be very complicated, but in broad terms, when you sell your main home, it's exempt from capital gains tax. There's a specific relief that relieves your main home. The problem is this relief depends on you being resident in that house. So as soon as we start talking about people leaving that house, then they're no longer in occupation and that relief is potentially at risk. If you take the case of a husband and wife and one of them leaves and they own the property 50-50, if the settlement causes that half to be transferred to the other spouse, theoretically that spouse is making a disposal, and if they're not living in the house, then potentially there's an element of gain. Yeah. Now, there are 3 other things to consider with that. One is that the period of occupation will count for the exemption. So if you're only out of the house for a short period of time, it's not the whole gain that's going to be chargeable, it'll just be a fraction. Yeah. Also, there is a period of grace given to everybody. It's nothing to do with divorce, it's a general condition that when you leave or when you sell a house, the last period is treated as if you lived there even if you didn't. When it was originally introduced, it was to help people who were struggling to sell their house. Okay. When it was first introduced, it was 36 months, so 3 years. You had 3 years to sell your house. Unfortunately, they have been tightening up on this quite a lot recently. First of all, it was slashed to 18 months, and now since April, it's just down to 9 months. So it really is, you need to start thinking about these things, because quite often 9 months isn't long enough to get everything sorted, particularly if you've got a complicated financial settlement. So you need to start thinking about A, whether there is going to be a liability, and B, whether there's anything you can do about it. Now, in certain circumstances, there is an election you can make. It's basically a deemed occupation election, which means that the spouse who is leaving the property can elect to essentially pretend that they lived in the house for that period, which then will give them the full exemption. The problem with that, of course, is that they then can't have another house elsewhere, because you can only have one at a time. So
they can't buy a house elsewhere, they can rent elsewhere, can't they?
Yes, they can rent. I mean, they still can buy a house elsewhere, but they wouldn't be able to benefit from the exemption on both properties. Yeah. So that's not a decision that the spouse that's staying in the house can make, because that's a decision for the person who's left, because that's essentially their tax liability that they need to address. That said, any tax liabilities ought to be included in an assessment of a financial settlement, so it is relevant to everybody who's involved. That only applies if you're transferring your half back to the spouse who lives there, but there are sometimes things you can do to try and improve the situation. And if you're in a more complicated situation, say there's a measure order where you get to stay in the house until the children reach adulthood, or perhaps there's the leaving spouse puts a charge on your house, again, that can get a little bit more complicated, and you really should take tax advice, because there may be future tax liabilities that need to be taken into account now to save people trying to come back at a later point and asking for more money, really.
Okay, so more alarm bells there just to have in your mind then, and just be aware that there might be some questions and some expertise to gain. Perfect, thank you. Sam, can we move on and talk a little bit about maintenance payments, which are a common part of a financial settlement, because there can be some tax implications to those two as well, can't there?
They can, although in most cases, if you're receiving maintenance, you're going to be receiving that free of tax. The argument with that is the person who's paying it is receiving that money elsewhere. Say it's salary, they're receiving that after deduction of PAYE and then paying it to you. So therefore, if you were to be taxed on its receipt as well, it would be double taxation. So a lot of people often find that quite a relief to know that they've got this income and actually it isn't taxable, and in most cases it isn't taken into account when looking at benefits and things. But it's also a bit of a bargaining tool in terms of a settlement, because the person who's paying the maintenance, if they wanted to commute that to a capital sum, for example, you know, you also ought to take into account that actually the amount that they're paying you is a net amount, and the value that they're losing is, you know, out of taxed income. So it's just something to bear in mind. But I think a lot of people are reassured by the fact that it's not taxable, and that actually that's kind of something that you can deal with separately from your own personal tax affairs, and you can deal with those separately and not need to worry about it.
Is a relief, definitely. So Sam, are there any other areas or alarm bells that you think we should raise here, or just have on our minds as we navigate divorce?
Yeah, I mean, there are always, whatever assets you're looking at, there are always things to think about. A couple I wanted to just flag, really, as you say, just ping those alarm bells a little bit, are pensions. These days, particularly if one spouse has a massive final salary pension scheme and the other one doesn't, you know, there could be a significant pension sharing order put into place. Now, pensions themselves aren't necessarily a big tax event, but if you were thinking of trying to divert that pension to your children, for example, then you could get in trouble. There was a recent tax case to do with inheritance tax, to make sure that you're not making a gift of the assets that you're receiving. Talking about inheritance tax, as I just mentioned, inheritance tax is only payable when you die, but there's a lot of tax planning that uses spousal exemptions for inheritance tax, and it often gives you just some more thinking time on a death to plan your tax liabilities. If you don't have a spouse, not only do you not have that thinking time, but you also only have one set of allowances. So if we're talking about the nil rate band and the residence nil rate band, that's only covering up to £500,000 worth of assets, which, you know, given house prices, we can all get there pretty swiftly. So if you want to, you know, depending on your age, obviously, if you're 25, it might not be a pressing issue, but you know, that you might want to start thinking about what you can do now to try and minimise that liability before it becomes a big problem as you get older. And the last thing I just wanted to touch on was trusts. You know, I do a lot of trust work, but in terms of a divorce, it may be that your spouse or ex-spouse was receiving money from a trust. You're unlikely to be able to benefit from that in future, and it's just bringing those kind of things into mind. And also that you might want to look at setting up a trust for your children, depending on the value that you have, because without being funny, a trust can protect assets from divorce of your children and protect it for future generations. So, you know, if you do have excess cash and you want to look at planning, perhaps that's something that you want to look at to protect your children and their families.
And it's far more straightforward and cost effective than people appreciate, isn't it, Sam?
What, setting up a trust?
Yeah.
Oh, I personally, I love trust. I'm a big trust fan. The problem is when people don't understand them and don't understand the purpose, then people can get into a pickle. If it's set up correctly and you've got the right advice, and most importantly, you know why you've got a trust and how to use it, then yes, it's absolutely perfect. And the trusts have a bad reputation for tax avoidance, but genuinely, they were set up in the 15th century to protect assets, and that's still the main purpose of them.
Perfect. Sam, thank you. That was a whistle-stop tour about tax on divorce, and hoping that gives you the appreciation of some things that should be on your mind, and to just bring up in discussions during the divorce settlement with your solicitor, with your financial advisor, and with a tax advisor. So Sam has put together the most amazing fact sheet, and I will share that link on the YouTube channel description. So look below and you will see it there. And that gives a summary of what we've talked about, and it's also on my LinkedIn profile and on my website, so that you can just have a summary of what we've talked about, just a little bit of a guide there to keep it in your mind and keep it fresh as you navigate your divorce. Thank you for watching. Please stay tuned, and we have a new video every week with a guest and a new video every week from me where I'm talking about the key aspects of financial planning on your divorce. Thanks all.